Should you bootstrap or raise money for your startup? What's going on, guys? Kieran O'Brien here. I am a 23-year-old entrepreneur and tech startup founder. In this video, we're gonna be talking about bootstrapping versus raising money. So for me personally, I've actually bootstrapped 2 companies to 7 figures in revenue, and I've also raised 7 figures in venture capital for a different business. And so I'm gonna be talking about the difference between bootstrapping and fundraising, and also my personal experience doing both. So first and foremost, what is bootstrapping? So the word itself derives from the term pull yourself up by your bootstraps, right? So it essentially means starting and scaling a business without any outside capital. And there are essentially 2 different ways to bootstrap a business. Number 1 is to start a business that has little to no startup costs. For example, a digital services business like a marketing agency. And that's actually what my first 2 companies were. They were both marketing agencies, and they were both fully bootstrapped to 7 figures in revenue, fully dependent on their own revenue to grow. The less common way to bootstrap a business that a lot of people don't really talk about is actually to start a company that could have a lot of startup expenses or a lot of startup costs that most people would typically go out and raise money for, but to just do it in a scrappy way. And there's a couple different ways to do this, right? So let's say that you're starting a software company, for example, and you don't want to go out and raise money, or you just want to bootstrap it to get validation on the product. You can go ahead, if you're technical, and just do all of the work yourself. This is one of the most simple ways to bootstrap a business, is to just sit down and do the technical work yourself. Basically, you are a 1-employee business at this point, and you're not paying yourself anything, and you're just bootstrapping your way to revenue. Another way to do this is to start a kind of dummy version or a dumbed down version of the business that you eventually want to start. So let's use a software company for an example again. If you want to start a software business, you could always start that business in its early phases as a blog or just a simple landing page with an email capture form to get validation on if your potential customers would actually potentially use this product if it was made real. And the cool part is you could actually even collect revenue by doing it this way. You could collect pre-orders, you could start on things like Kickstarter and actually collect money from your ideal customer before you've ever even built a product. Now, what is fundraising? So on the flip side, fundraising is going out and collecting money from outside sources, oftentimes investors, to fund the early growth of your business. And so there's a few different ways to fundraise, right? There is the angel investor route, where individually wealthy people believe in you as a founder or as an entrepreneur, and they want to back what you're doing by writing a small $10,000 maybe to $100,000 check into your business. And then there's venture capital, which of course is the big institutional money. These are millions and millions of dollars in most cases in terms of the check size that they're writing. And this is for usually later stage businesses that have already achieved some sort of product market fit or some sort of growth. And you're gonna go out and raise an official fundraising round like a Series A or Series B. And I'm actually gonna make a separate YouTube video on the different ways to fundraise and the different processes for fundraising. And so look out for that on my channel soon. So let's talk about the pros and cons between fundraising and bootstrapping. So the pro of fundraising is the ability to blitz scale, essentially bypass all of the early phases that you might run into with a bootstrap business where you don't have to really, kind of go step by step. You can skip a whole bunch of steps by raising a lot of money from angel investors or venture capitalists early on as a fundraised VC-backed business. You can skip a lot of those steps and actually jump right into blitz scale growth. And that is essentially the thought process behind raising money, is that you can jump right into the meat of it. And that's why fundraising is great for people who know what they're doing going into it, who have product market fit, but it can actually be kind of a blessing and a curse for founders and entrepreneurs who maybe haven't found their ideal customer yet or haven't found product market fit. Giving a bunch of money to a business like that, you actually might just burn through it trying to find those things versus a bootstrap business that kind of has to figure it out and kind of penny pinch along the way. So of course there are pros and cons to both. Now the pros of bootstrapping is that you maintain control of your business. Now this is one of the most important things because of course when you're fundraising, you are selling a portion of your business in exchange for money. And so in a bootstrap business, you're not doing that. you're maintaining control, you're maintaining your board seats, you're maintaining your equity, and of course you're maintaining your flexibility, right? You could take a week off on vacation as a Bootstrap founder if you want to, and nobody could tell you not to do that. You could hire an employee or fire an employee, and there's no repercussions really. There's nobody in your ear telling you what you can and can't do as a founder because you own the business yourself, and there's nobody that can tell you otherwise. And so a lot of founders and entrepreneurs like the idea of not having shareholders, stakeholders, boards of directors, and all of those things. But of course, there are pros and cons. And so let's talk about the cons. So of course the cons of fundraising, like I just mentioned, is a lack of control, right? You're gonna have to sell, of course, equity in your company, but you're also gonna have to give up board seats in later stages of fundraising. And overall, you're just not going to have the final say in decisions that the business is going to be making. And then of course, things like dilution and overcapitalization. I mentioned this briefly, but having too much money as a startup, especially in the early stages, can actually hurt you more than it helps you. And that's one of the things that actually leads to the failure or the bankruptcy of a lot of VC-backed companies, is having too much money and not deploying it efficiently. Now, the cons of bootstrapping is, of course, the most obvious one. You have less resources. You have less money in the bank. You have less connections from a network of investors that you might have with a VC-backed company. And so overall, you just have less opportunity for hyper growth, right? And the other thing, of course, is most bootstrap companies have at least one or two or maybe a few dozen VC-backed competitors. And so you're going into this with less resources and less connections, and you're also competing against people who have all of those things. And so these are definitely things that you're gonna wanna look into when you're trying to figure out if you're gonna fundraise or not for your business. Figure out how many VC-backed competitors do I have in this space, and then are they actually competitors? Are they actually going to give me a run for my money? Or do I have a chance as a bootstrap founder to actually go head to head with these guys and compete with them? And there really isn't a right answer here. There are plenty of bootstrap founders that are simply just going to outwork and be extremely scrappy and give a VC-backed competitor a run for their money because they've gotten lazy or complacent with all the money in the bank, and they think that they're just gonna pay their way into product market fit, and a bootstrap founder could really come in and change the dynamic there. So let's talk about the best type of businesses to bootstrap. So of course, service-based businesses. So marketing agencies, any sort of service that you're providing that isn't a product or a digital product, any sort of service-based business is a great business to bootstrap. And like I said, my first two businesses were service-based businesses, selling advertising services, and those were great, really easy businesses to bootstrap. Another commonly bootstrap business is content businesses, right? So blogs, even YouTube shows, podcasts, things like that. These types of businesses can generate a lot of revenue just purely putting out content, and oftentimes they are bootstrapped. Now, there are a few cases of these types of content machine businesses that have raised money even from venture capitalists, but it's not very common, and most people that are in the content game go ahead and just bootstrap their businesses. And then of course in the software space, low and no code tools, SaaS tools that are relatively simple to build, especially if you're technical yourself or if you have a technical co-founder. A lot of these low, no code, very basic software tools are often bootstrapped, and sometimes they even turn into very complex versions of a software tool, and they just start out as a very basic tool that was bootstrapped, and maybe they go on to raise money later. So there's really no right way to do it. You just have to figure out what the best starting point is for you, and sometimes starting off bootstrapped is the best way to go. Now, what is the best type of business to raise money for? I mean, the short answer is any business that absolutely requires a lot of upfront capital. And so this could be very complex softwares, anything in like AI and machine learning. A lot of these softwares, they're not going to see revenue, much less profit, for a very long time. And so they require upfront capital. And then of course, consumer packaged goods companies, direct to consumer companies, any sort of business that has tons of physical inventory, requiring shelf space, packaging, all of these types of things cost a lot of upfront money. And so that's why you see a lot of consumer packaged goods and direct to consumer companies raising big funding rounds so that they can afford these massive expenses and these massive invoices that they have to pay early on. And they also have high customer acquisition costs. So in a consumer packaged goods business, you're oftentimes losing money to acquire a customer, hoping that they return, they like your product enough to continue ordering from you and increasing their LTV. And so they need that money upfront from VCs and angel investors to afford their customer acquisition cost. And then the last type of business that I was kind of just giving here as an example of businesses that often fundraise is research-based businesses. So there's a lot of this in the scientific and medical space where businesses don't even have a product or a service to sell. They literally exist to do research and to solve problems that they don't even know if they can solve. And so there's a massive market for that in the VC space of businesses that are simply just doing research and paying scientists to try to solve a problem. And the bet that the VC is taking is that, yeah, if they solve this problem, it's going to be a massive, massive cash cow. And basically we just have to keep funding it until they get there. And so that is another common business that is very oftentimes fundraised for and that could pretty much not really be bootstrapped by any one particular person. So let's jump into my personal experience bootstrapping. Why did I bootstrap my first two businesses? I'm actually gonna talk about my second business, specifically my marketing agency Shop Accelerator that I've talked about here many times on my YouTube channel. So why did I bootstrap that business from day one? Well, the most important thing is that it was profitable from day one. We actually went from $0 to $100,000 ARR in like 6 or 7 days just by selling one offer. And so there wasn't really any necessary reason for me to fundraise because we had cash in the bank from day one. And of course the fulfillment was simple and free. So fulfillment in the beginning, because it was a service-based business, was just me. I was sitting down at the computer, I was writing the ad copy, I was creating the ads. And so I didn't need to raise money to fulfill my services. I think the third reason is that the unit metrics and the business model were not really conducive to a venture backable company. VCs are looking for high growth, high return. At the end of the day, service-based businesses are usually not high growth, high return businesses. They're great for cash cows, they're great for high revenue, but they don't really have tons of defensible IP. They don't really have potential to massively scale. And as you scale a service-based business, you also scale your expenses along with that, right? And so they're not very venture backable businesses, and so there just really wasn't any reason to fundraise for that company. Now, my second company that I did raise money for, called MediaKits.com, we were actually a SaaS tool, and we did not do revenue for the first year and a half. We put off revenue in order to acquire users. And so we actually needed to fundraise for that business. And so the most important thing is I did actually bootstrap Media Kits for the first 6 months or so. And I put almost $100,000 of my own money into that company, and we still didn't even have an MVP, a minimum viable product. And so when we got to that point, I realized that we needed outside capital because I couldn't keep funding it myself. It was getting really expensive. And so we also had investors who knew what we were working on, my business partner Casey and I. There were investors who knew that we were working on this idea and they wanted to invest because they saw the potential in it. And so now we had kind of this perfect storm where I didn't want to continue funding it myself. We were still pretty far away from doing any sort of revenue or keeping my costs down. And we also had investors that were interested in giving us money. And so the combination of that kind of drove us to go ahead and raise some money for the business, and we ended up raising just under $1.5 million for that company. And we also had a very clear path to a potential acquisition, and we had early signs of product market fit. So we had influencers and creators who were users of the platform that were telling us how much they loved the product. And so we were pretty confident fundraising for that business because we knew that there was a massive upside potential for not only the product, but for our investors as well. And of course, if you guys saw one of my recent videos, that business did just recently get acquired. So everything worked out nicely. And so I think the last reason why we decided to fundraise for that company was that the service that we did end up selling, the paid version of Media Kits, was relatively low cost. It's like $20 a month. And there was tons of upfront development costs incurred in order to build that product. And so we had multiple engineers making 6-figure salaries to build this product, and we were selling it for $20 a month. So the delta between that, right? You have to sell thousands and thousands of memberships to recoup those costs. And so that's just the reality of early stage software businesses, is oftentimes you're burning way more money than you're actually making for the first couple of years. So, should you fundraise or bootstrap for your business? After all, that's the answer that you probably came here to find, right? And so the answer is, it's a unique decision for every founder, and it's very dependent on your unique circumstances. So what we're gonna do is we're gonna dive into the thought processes and some of the questions that you can ask yourself to help answer this question for your unique situation. Question number one, what is your desired outcome? Do you want to be a billionaire? Do you want to be a publicly traded CEO ringing the bell on Wall Street one day? Or do you want to have a nice lifestyle business that makes a bunch of money, maybe even millions of dollars a year, and sit on a beach in Bali drinking Mai Tais, right? There's no wrong answer. Each person has their own unique desired outcome, and so ask yourself, what is that desired outcome for you? This business that you have in your head, or this business that you may have already started, which one of those outcomes is most interesting to you? Now, the second question is, what are the startup costs associated with this business, right? How much is it going to cost you out of pocket for servers, web hosting, marketing, customer acquisition costs? All of these things can add up really quickly and get really expensive. So how much is that gonna be? And can you afford to do these things out of pocket for a period of time until the revenue and the profit of the business exceeds what you're putting into it out of pocket? Number three, are there big VC-backed competitors with big market share, right? So in other words, are you going to be in a position as a bootstrap business to come and take market share from big VC-backed companies? Now, there isn't a right answer for that, right? There are plenty of bootstrap businesses that have successfully taken market share from big lethargic VC-backed businesses. And there are also probably even more stories of bootstrap businesses who have been the new kid on the block. They come in trying to take market share and they just get absolutely clobbered because they just don't have enough resources. So either way, it really comes down to your scrappiness and your unique approach as a founder. And you have to be honest with yourself and decide, is this a game that I'm willing to play? Is this a risk that I'm willing to take? One of the best ways to help you make this decision is actually to use tools like Crunchbase to go ahead and do market research and figure out how much your competitors have in funding, how much estimated revenue they do, how many employees they have. All of these things are indicators of how difficult it's going to be to take market share and to take customers from them and provide their customers with a better customer experience at your business or with your product. And number four, I think this is perhaps the most overlooked thing that you can ask yourself when deciding to fundraise or bootstrap, which is, can you actually fundraise, right? Fundraising is a full-time job for most founders. It's going to take you out of commission, away from building your company and working on your product for many, many months. And so this is a big gamble for a lot of early stage startup founders. Going out and trying to do a fundraising campaign for your business can completely distract you from your business, and it can actually even cause you to burn out and become lazy or lethargic towards your own company. And so these are all real things that I've seen firsthand, that I've even experienced firsthand as a founder. And so you have to be aware of these things when you're deciding if you want to fundraise or not. And so understanding if you're even capable of fundraising in the first place is very important. Now, what do I mean by being capable? Well, there's a couple factors. Number one is, do you have the network and the connections for people that would want to back you, right? Have you fundraised in the past? Have you had successful businesses in the past? If those things aren't true, you might have difficulty fundraising for your business, and it might be more effort than it's worth. Now, the second thing is, even if you've fundraised in the past, and even if you've had a successful business in the past, are you good enough at sales and selling the vision to go out and get people to believe in what you're building this time around? Now, some founders are great at selling themselves and selling their business, and some founders aren't. And so if you know that you're not, you should probably work on building that skill set or partner with somebody who already has it. And so making sure that you're actually capable of raising money in an efficient and timely manner is definitely one of the most important questions that you should ask yourself when deciding if you should raise money or not for your business. So here's what I actually think is the best approach when deciding to bootstrap or raise money for your business, and I call it the hybrid model. Essentially what this means is you're going to bootstrap the business until KPI or until product market fit, whichever comes first. Now, KPI could be something like a revenue milestone, it could be something like a user milestone, and then product market fit is also dependent on a few different things. There's really no perfect definition for product market fit, but it could mean that a certain percentage of your users have a certain satisfaction rate. It could mean that your organic mouth-to-mouth growth of your business hits a certain point. And so when you hit one of these things, one of these KPIs or a perceived product market fit, this is when you can go out and fundraise way more effectively. A business with product market fit and a business that has traction against certain KPIs is going to have a much easier time convincing investors that there is massive upside than a business who doesn't have these things. So the benefits of the hybrid approach is, number one, of course, it forces you to be scrappy and keep costs low in the beginning. Even though you might fundraise down the road, you know that right now, as it sits, you're bootstrapped. So you're pulling money out of your own pocket, or you're using your own revenues, which are probably very limited, to fund the business. And so therefore, you're going to be much more aware of the money that you're spending in order to drive new business and acquire new customers. The second thing is it gives you more options. Once you do reach KPI or product market fit, it gives you more options and will give more conviction to your investors. And then of course, number three is it protects you from raising money for a pre-product or a pre-revenue company, which is actually a mistake that I made when I was raising for Media Kits, is we were raising for a pre-product and pre-revenue company. And if we had just waited a little bit longer until the product was launched, we had more clear signs of product market fit and more revenue, we probably could have raised at much more favorable terms with a higher valuation, less dilution, et cetera, et cetera. And so going into my next startup, when I do fundraise for a startup in the future, I'm gonna make sure that I hit some sort of KPI or some sort of sign for product market fit before I go out and fundraise, because that's the best way to get the most favorable terms in a fundraising environment. So some of my closing thoughts here is I do believe that the hybrid approach is the best approach. If you can afford to, go out and create some sort of bootstrap version of the business that you might eventually fundraise for. And who knows, maybe you'll get to a point where you actually have so much traction that you don't even want to fundraise. And that would be absolutely incredible. But either way, I do think that the hybrid approach is the best approach. And I do believe that every entrepreneur's very first business should absolutely be bootstrapped, at least in the beginning. I think one of the biggest curses as a talented or skilled entrepreneur, if it's your first at-bat, if it's your first business, one of the worst things you can do for yourself, your reputation, and just your respect for how business and customer acquisition works is to go out and raise a bunch of money for a product or a business that has not been validated yet, and that's also your first time doing something. I think that that is a recipe for disaster, and that every entrepreneur's first business should absolutely be bootstrapped. It'll provide you with an understanding and a respect for the fundamentals of business, and of course provide you with more ammunition to fundraise down the line because you've learned so much through that bootstrapped experience. So with that being said, guys, thank you so much for watching this video. I really hope you got some value. Like I said, my name's Kieran O'Brien. I make all sorts of videos here on my channel about startups, entrepreneurship, business, sales, fundraising, etc. So check out my channel if you haven't already. Drop a subscribe and a like on this video, and I'll see you guys in the next one. Peace.